Hey there! What if I told you that your money could grow while you sleep? No, it's not a scam. It's called investing. But here's the problem. If you don't know the basics, you might as well be throwing cash into a wishing well. Today, we're breaking down the easiest ways to invest, from stocks and ETFs to bonds, mutual funds, crypto, real estate, and even sneakers. Yes, really. By the end of this, you'll know exactly where to put your money to make it grow without turning into a Wall Street nerd. First, let's talk about what investing actually is. Think of it like planting seeds, except instead of water and sunlight, you use money and patience. The goal? Make your cash grow over time, but unlike gambling where you might lose everything on a single bet, investing is about playing the long game. Here's a fun scientific fact. Thanks to something called compound interest, your money can grow exponentially. Albert Einstein even called it the eighth wonder of the world, and he was pretty smart. Imagine a snowball rolling downhill. The longer it rolls, the bigger it gets. That's exactly how your investments can grow if you're patient. Now let's dive into our first type of investment, stocks. Stocks are like owning tiny slices of companies. When you buy a stock, you're essentially buying a small piece of that business. If the company does well, your stock grows in value. For example, if you had bought one share of Apple in 1980 for $22, today it would be worth over 100,000 after accounting for splits. That's like turning a pizza into a private jet. But beware, stocks can be volatile. One day you're up, the next day you're crying into your cereal. To avoid that, smart investors diversify, which brings us to our next investment types, ETFs and mutual funds. ETFs, exchange traded funds, are like smoothies with tiny bits of every fruit. So instead of buying individual stocks, you get a fund that holds hundreds or thousands of them. Mutual funds are similar, but are like hiring a personal chef. You pay a pro to pick investments for you. The problem? Most chefs don't cook better than a simple ETF, and they charge you extra for the privilege. Pro tip, index funds, a type of ETF, are perfect for beginners because they track the whole market at low cost. Even Warren Buffett loves them. Now let's talk about bonds. If stocks are roller coasters, bonds are the relaxing boat ride of investing. When you buy a bond, you're essentially lending money to a company or government that pays you back with interest. For example, a 10-year US Treasury bond might give you 3% interest annually. Not exciting, but safe and steady. Next, let's talk real estate, where you don't need to be a millionaire to invest. You can buy property to rent out or invest in REITs, real estate investment trusts, which are like ETFs for buildings. Fun fact, if you bought a house in San Francisco in 1980, you'd be a millionaire today. If you bought it in Detroit, though, maybe not so much. Then there's cryptocurrency, the wild west of money where fortunes are made and lost in the time it takes to microwave a burrito. Digital currencies like Bitcoin have made some people multi-millionaires. A $100 investment in 2010 would be worth millions today. But they're extremely high risk, so if you want to buy crypto, only invest what you can afford to lose. For more adventurous investors, there are commodities like gold and oil, P2P lending, where you act as the bank, and even collectibles like rare sneakers or Pokemon cards that can sometimes yield huge returns. The golden rule? Diversify. Never put all your money in one place. Studies show that diversified portfolios outperform single stock bets over time. Just ask anyone who put everything into Enron or FTX. So here's a quick rundown. Stocks offer high growth potential but can be volatile. Great for long-term investors with strong stomachs. ETFs provide instant diversification with lower risk than individual stocks, perfect for beginners. Mutual funds offer professional management but usually underperform after fees. Bonds give steady, predictable returns but can often lag behind inflation. Crypto promises huge gains but comes with huge risk. Real estate builds wealth through appreciation and rental income but requires more capital and work. For most beginners, a simple ETF that tracks the total stock market is the smartest starting point. It's diversified, low cost, and hands-off. So there you have it, an investing 101 on how to grow your money without losing your mind. And remember, investing isn't about getting rich overnight. It's about steady growth. So start small, stay consistent, and let time do the heavy lifting. As they say, the best time to start investing was yesterday. The second best time is right now. So go plant that money seed and watch it grow. Let me know in the comments below what you would like to learn next. And if this helped, give it a like. It's the closest thing to free money on YouTube. Now, go forth and invest wisely.